Welcome to Group 4 project presentation. Today, Tom, Michael, and I will discuss our analysis of Wells Fargo and Company and evaluation of its management strategies and investment portfolio. Understanding interest rate and term structure is essential for managing portfolio's risk exposure, particularly in the case of a financial giant like Wells Fargo. Portfolio duration, a key metric, gauges the portfolio sensitivity to interest rate fluctuations. It estimates the potential prices change of fixed income portfolio in response to shifts in interest rates. Assessing interest rate risk exposure allows us to evaluate how changes in rates could impact the value of a portfolio, offer insights into vulnerability to market fluctuations. Armed with this knowledge, one can make informed investment decisions to mitigate risk and optimize returns. Given the importance of interest rates in shaping market dynamics, a thorough grasp of these concepts is indispensable to navigate the complexity of the financial landscape. The provided summary outlines the detail of two bonds issued by Wells Fargo. The first bond has a coupon rate of 5.55% and matures on August 1st, 2035, while the second bond offers a coupon rate of 7.95% and matures on November 15, 2029. The summary also breaks down the cash payment and present value for each year of the bond's term, along with their corresponding weights and weighted maturities. The analysis concludes with the calculation of portfolio duration and interest rate risk, considering the weights and duration of each bond within the portfolio. The portfolio duration is determined to be 11.96 years, reflecting the weighted average maturity of the bonds and indicating the sensitivity of the portfolio to changes in the interest rate. The analysis revealed that the portfolio has a portfolio duration of 11.96 years, indicating its high sensitivity to changes in interest rates. A 1% increase or decrease in interest rates is anticipated to respectively lead to an 11.96 decrease or increase in the portfolio's value. This underscores the significant impact of interest rate fluctuation on the portfolio's performance. Moreover, the higher duration implies heightened exposure to interest rate risk, suggesting the potential for greater volatility in portfolio value. By spreading the investment core asset and various sensitivity to interest movements, the portfolio can potentially enhance its resilience and reduce overall exposure to fluctuations in interest rates, thereby promoting stability and mitigating potential loss. The table presents a summary of equity holders, including the symbol, issuer's name, class, CUSIP, value, percentage of total portfolio, number of shares, current price per share, earnings per share, and price to earnings ratio for each holder. Microsoft Corporation, Apple, and constitute the largest holdings. Each holding's PE ratio varies, with Microsoft having the highest at 34 and SBI the lowest at 6.26, reflecting differences in valuation and investor sentiments across holdings. The analysis of Wells Fargo stock market and equity valuation provides valuable insight into investor sentiment and growth expectation on key holdings. Microsoft and Apple exhibit relatively high PE ratios, indicating investors' willingness to pay premiums for earnings. Conversely, the SPDR and S&P 500 ETF trust represents a P ratio, suggesting that investors are paying less for each dollar of earnings from a diversified portfolio of S&P 500 companies. Invesco QQQ Trust displays a lower PE ratio than Microsoft and Apple, indicating reduced payment for earnings from a basket of NASDAQ 100 companies. Lastly, iShares Russell 2000 ETF showcase a moderate premium of earnings from small cap companies in the Russell 2000 index, positioned between large cap tech stocks and broad market ETF. Overall, these insights inform investment decision portfolio management strategies, highlighting diverse market sentiment and growth expectation across different sectors and asset classes.
Thank you, Terzette. As we move on and we look at Wells Fargo in the mortgage-backed security and mortgage lending sector, our quick timeline will show us at the very center. After suffering incredible losses and dealing with some regulatory hurdles, Wells Fargo Company has instituted a core business refocus plan that has led to a huge divestment in their exposure to mortgage-backed securities and mortgage lending. More on that to come. As we get into some of the metrics, very quick year-over-year loss 2021 to 2022 from home lending. And as a result, you can see their strategy to back away from those in the next chart. As we go down, this is the one bright spot in the bottom left corner. The interest income to expense ratio actually rose as interest rates started to rise 2022. But you can see clear losses in the commercial and consumer sector, and an interesting chart that we'll go into a little bit more on our next slide on the loan maturities. 2021 and 2022 obviously yielded significant losses in Wells Fargo's real estate holdings. Their decision to back away from their position as market leaders helps them hedge risk associated with interest rate volatility as well as prepayment risk. It's important to note in 2022, revenue increase was driven by higher net interest income reflecting higher interest rates. So the primary concern for Wells Fargo is in prepayment risk category. And as you can see, we have an inverse yield curve when it comes to our effective annual rate, and the break-even point isn't until after 20 years. So clearly, if they are wanting to hedge risk and increase liquidity, the option to sell some of their mortgage-backed securities and some of their assets under management to third parties is an effective way to increase liquidity and reduce risk.
Exchange exposure. In essence, Wells Fargo's economic position faces benefits and potential drawbacks during fluctuations in exchange rates. Beginning with the opportunities presented, favorable exchange rates and rising interest rates give banks opportunities to increase in earnings by pushing up rates charged on loans, and higher net interest income reflecting higher interest rates as well as higher loan balances. Highlighted in the middle column, these changes could also increase the cost of liabilities and decrease the value of investment securities held on assets, which could adversely affect profit margins and the value of assets. Fluctuations can significantly impact Wells Fargo's performance, particularly its lending and investment activities. Exchange rate changes can affect loan demand and repayment abilities, investment returns, and overall financial stability, posing a threat to the bank's profitability. Mitigations of this risk observed by Wells Fargo are currency swaps and hedging activities. taking an active approach to minimize the downside risk of foreign exchange rate fluctuations. Measuring and managing exchange rate risk exposure is important for reducing a firm's vulnerabilities from major exchange rate movements. Currency risk hedging strategies entail eliminating or reducing the risk. In terms of Wells Fargo, the goods and services between banks are not tradable, but many factors do contribute to where clients invest their money, most significantly including taxes and interest rates. If there is an appreciating currency, then there is more demand overseas, which reduces the appreciation of domestic assets and thereby the expected return. In the top right, we see the yearly comparison provided by the OECD of purchasing power parity and exchange rates. As we see, closely compared with the US is the UK and the EU. Looking below, we see the major interest rates set in the US and Europe closely aligned during 2023. Looking forward for Wells Fargo, if the Federal Reserve lowers interest rates to combat inflation, how would this impact Wells Fargo? Theoretically, a rise in foreign interest rates relative to domestic would depreciate the domestic currency, reducing the return on domestic assets. If we were to see a price level increase by 10% in Europe while falling by 10% in the US, taking the current exchange rate of 1.08 euro per US dollar, we would see the exchange rate expand to 1.30 euro per US dollar, reducing the expected return on domestic assets. Specifically at Wells Fargo's foreign exposure now, with foreign loans representing loans given by the bank to customers outside the country where it is situated through its foreign branches and subsidiaries. We see that Wells Fargo's share of foreign loans as a part of total loans was 9.1% in 2022. Foreign deposits as a share of total deposits was 1.5%. Utilizing the real broad effective exchange rate for foreign exposure, a 10% depreciation of the dollar would increase the liability of foreign loans and deposits by 4%, respectively.
For our next section, we'll be talking about the efficient market hypothesis and how it pertains to Wells Fargo's investment portfolio. We used an insider's perspective by leveraging our professional network and contacting Barrett Combe. Barrett Combe's a managing director with Wells Fargo. He's been with the company for 15 years, and with his help, he identified a couple of ETFs that would be symbiotic with some of their investment strategies, as well as provide this nice little pie chart giving a sample spread of how they might allocate some of their resources. And here we have our 6 sample ETFs as they compare to the New York Stock Exchange Composite on the top right and the S&P 500 on the bottom. You can see a tight spread to both market indices, whether we look at the ETFs individually or as a composite. So as we take this information and derive our linear regression, you can see the scatter plots where the performance of both the ETF composite as well as the S&P 500 indicate a very tight spread. We've got a beta of less than 1 at 0.85, and we've got a 23% reduction in value at risk, which is an internal statistical average that Wells Fargo uses to determine volatility such as interest rate risks to their internal portfolio, and we can see that value at risk average goes down from 2021 to 2022 as a result of some of their divestments.
A basic measure of bank profitability is the return on assets, which divides the net income of the bank by the amount of its assets. Essentially, it indicates how well a bank's assets are being used to generate profits. Performance can also be measured by the return on equity. The bank's equity holders arguably care more about how much the bank is earning on their equity investment, an amount that is measured by the net income per dollar of equity capital. Wells Fargo sees an increase in 2023 over 2022 that indicates improved management efficiency in regards to assets and capital. Look at Wells Fargo's balance sheet. Banks manage the amount of capital they hold to meet capital adequacy requirements, but they do not want to hold too much capital because by doing so, they will lower the returns for equity holders. We see changes from 2022 to 2023 in amounts borrowed from Wells Fargo and amounts borrowed by Wells Fargo. These increases in time deposits, such as certificates of deposit, and short and long-term debt, are likely due to adjustments in Wells Fargo's liquidity management strategy due to higher federal interest rates, while equity liability ratio consistency indicates Wells Fargo's effort to maintain a steady level of risk.
As we examine Wells Fargo's exposure to private equity and venture capital, we found the SEC 10-K filing on the organizational flow chart indicating the affiliated venture capital and private equity businesses were found in the corporate arm. It's important to note that they do not have any heuristic exposure from a borrower's perspective, but some of the affiliated venture capital and equity businesses did suffer losses that we will dive into in our next slide. In the notes of the SEC 10-K filing, the impairment write-downs, which are losses on equity securities, included an undisclosed amount of private equity and venture capital investment, but the trend line definitely shows significant losses, which led them to their decision to divest roughly $2 billion of those private equity assets. We can also see private equity as a percent of the total equity securities coming to about 4.4%. Less than 1% of the corporate assets, and from a losses perspective, you can see 5.41% of the total corporate losses, and losses versus loan loss allowance, less than 1% as well. And it's important to note that these figures only incorporate the corporate arm. If we expand this to Wells Fargo Company as a whole, these numbers become numerically irrelevant. Because the scope of private equity and venture capital investments comprise such a small portion of Wells Fargo's assets, even from the corporate arm of the business, and the loan losses account for less than 1% of the loan loss allowance, we've determined that they have very minimal exposure at this time. But they've maintained partnerships where they can jump back into the arena when the time is right. And you'll see that their new partnership to create Overland Advisors will lend directly to middle market companies.